All right, well, for decades, property investment has been touted as one of the best methods for building long-term wealth and financial security, but that's only if you get it right. Damn it!
Yeah, many real estate influencers and online gurus will equate success with a huge portfolio. Others will encourage you to buy new rather than existing. So how can you separate bold claims from the cold, hard facts? Well, to help us debunk property investment myths, we say hello to authors Bryce Holdaway and Ben Kingsley. So good to see the both of you.
Thanks for having us.
Bryce, start with you. The idea that you need lots of properties to retire comfortably, lovely idea. Is that actually true?
The answer is no, because for a lot of people, there's about 2.3 million property investors in this country with about 26 million people. So less than 10% actually do it. And of those who actually do it, 3 out of 4 stop at 1. So the reality is most people don't have heaps and heaps of property. So if it needed that, most people wouldn't be successful. So for us, it's combining your super with a couple of investment properties usually gets the job done.
Most people don't even have one,
yeah,
right?
Exactly. Most people are struggling with the rent at the moment. Ben, one of the other myths is negative gearing is a great strategy. Is it? Isn't it? Oh, gosh.
Well, if I said to you, Sally, let's go and start a business in a corner shop and let's run it at a loss, would you think that that's a smart business? So it's not.
I don't have much business sense, so yeah, I probably would say, let's do it.
Well, the reality is we don't want it running at a loss over a long period of time. So it's a moment in time where effectively the income is not covering the costs.
Yep.
But as we retire the debt and the income keeps increasing, we start to get that passive income as well as that long-term capital growth. So it's not a strategy, but it does assist us in terms of getting into the market.
It's a little bit of a helper then. Okay.
Yeah, a little bit of a helper.
Bryce, unpack this one for us. High rent means a great investment. Is that true?
Not necessarily. And the easiest way I can explain it is usually if you're chasing capital growth in this country, it has lower rent. And if you're chasing higher rent, it has lower capital growth. So for most people, they're trying to build their wealth base. So therefore, usually going for capital growth first.
Yep.
So not necessarily, but imagine you're an outlier and you just received a big inheritance and you're close to retirement, and what you really want in retirement is income. So in that scenario, it might make sense, but to have it as a blanket rule is not true. And in our sort of teachings, we're like, let's build the base first, and the rent will get dragged along as you build that as you build the portfolio.
Does that mean size does matter? Like when you buy like a really tiny apartment, a teeny tiny one, versus say like if you can stretch to a house but in a suburb where it's cheaper, like does it matter?
It's almost. Like the more land you can get, the better, but there comes a diminishing return on that. So the land value is more important than the land content. So the closer you can be to, like we're in Sydney, so the closer we can be to Sydney, the better, because that's where the economic drivers are. The further we go out means commuting and all those sorts of things. So
you're almost saying that location is everything. Is that what you're implying?
Location.
It's like that's a thing.
We say location does 80% of the heavy lifting.
Yeah, right.
Right.
Ben, the saying that the market always goes up, that's saying not as clear as it sounds when you first hear it.
No, that's right. I mean, obviously we have this perception over the long period of time that house prices just keep going higher. Yep. But the reality is that there are times where supply does exceed demand and economic situations deteriorate in certain locations. So you only need to look at mining towns and those types of things where people have lost a lot of money in those areas because they've had irrational exuberance. They've been sold this idea of quick wins and quick gains, but it's not always the case. So if you think in the long term, maybe, but there are definitely risks when it comes to when you buy and where you buy.
All right, well, let's talk about that, because it's not just about the property, it's about the way you invest and the way you manage it. But can you give us like a bit of detail about how we can do it so we can, I don't know, retire, do you reckon next week? Just in case.
Well, we might not be able to do next week. We might be able to do the week after. But look, for a lot of people, they're looking to buy an investment property and thinking my budget's already under stress. But there's ways that you can use equity that you've currently got. There's ways that you can structure your lending and your loans in a way that has the tenant and the taxman paying a lot of the bills. And then if you are clever with the way that you structure your financing, quite often a lot of people can actually find money in their budget that was allocated to incomplete loan structure that they could redirect towards an investment property without impacting the family budget.
Right. So think long term. Yeah. Think long term. Asset selection, borrowing power, cash flow management and defence is a nice little framework in terms of how to think about things.
There's one topic that gets a lot of attention. Should you buy a new or recently renovated house or an existing sort of older house or apartment?
Yeah, so obviously we're always attracted to this new. because we're thinking, well, we would like to live there, so would our tenants. We're attracted to this idea of high depreciations, and we're thinking that's what grows in value. But Bryce mentioned it earlier. The secret's in the location, the secret's in the land. So ultimately what we're trying to do is get that land in the right location, which also has that great amenity, all of the infrastructure and so forth, because property is an asset that we also look at from an owner-occupier point of view, right? So, you know, we from an investor's point of view, we should be always thinking about what owner-occupiers are doing, and we should be following them as investors, not necessarily creating or attracted to the new, because it's normally, if it's lots of new, there's a risk of oversupply.
Okay, I've got to cancel all those gold taps then. That's what I'm hearing.
What a shame. That would have been beautiful.
No, put them in yourself. Get the old one and then put the new gold taps
Yes,
in
they could
yourself.
match the gold toilet I've got at home. Thanks, gents. Really, really important stuff. And, yeah, thanks for breaking it down for us. I'll get the cheat sheet from you later on. And, of course, if you want more from Bryce and Ben, their latest book, How to Retire on $3,000 a Week, is out now.